Good afternoon, everyone. My name is Curt Altig, and I am the chairman and founder of Builders Capital. I wanted to spend a few minutes with you this afternoon talking about the impact the coronavirus has had on the U.S. mortgage industry. Prior to founding Builders Capital in 2009, I spent the previous 18 years as an executive in the mortgage industry building large retail and wholesale mortgage origination channels across the Northwest. And as we came into the Great Recession, and therefore the start of Builders Capital, one of the things that I carried forward with me from my time in the mortgage industry was a keen understanding of the importance of a properly functioning mortgage market on the U.S. housing industry. So before we get into the impact that coronavirus has had on the industry, I want to level set a couple basic terms. We are going to break the industry, the mortgage industry, into two basic buckets: conforming and non-conforming. Conforming consists of loan amounts and loan products that handle loan amounts $765,000 and less. Loan amounts that are $765,000 and more, we're going to refer to those as non-conforming. We are also going to include home equity lines of credit, or HELOCs, in the non-conforming bucket as well. One of the other important things to understand about the industry and those two basic buckets of product is that the conforming end of the industry is highly functioning, and the federal government has proven to us time and time again they have an abiding interest in making sure that that market is highly liquid. Those loans are originated, sold, bundled, and securitized on Wall Street. And again, the Fed has always kept that market very liquid. The non-conforming is a bit different. Those loans are originated and held on the balance sheet of the largest banks in the nation, for the most part. So let's talk about what's happened. Well, most simply stated, the impact the coronavirus has had on the industry is it has made it much more difficult to obtain financing at both the conforming and the non-conforming side of the industry. An example of that, within the conforming bucket, you have FHA loans. FHA loans might be the most prolific loan product in the U.S. and is the common product chosen for the first-time home buyer. Prior to the coronavirus outbreak, the minimum FICO score or minimum credit score to obtain an FHA loan was 580. You are now hearing standards set at the originator level, by the way. This is not a change of the FHA program as established by HUD, but you are hearing limits upwards of 640. On the non-conforming side of the industry, you are not only seeing increased requirements for FICO scores having jumped from 660 to 700, but you're also hearing of additional requirements for 6 to 12 months reserve of payments after closing and significant deposits being at the bank that is holding the loan. So for example, Wells Fargo originates a jumbo loan and requires the customer to have a minimum deposit of $250,000. So again, simply stated, the impact has been, it is much harder now to obtain a loan. Specific to the non-conforming, one of the other major changes that has taken place is those products are now only available, for the most part, direct from the source. So let's talk about how loans are originated for just a second. In the industry, there are two basic types of loan officers. There are mortgage brokers and there are mortgage bankers. Mortgage brokers, by definition, have the ability to originate loans and send those loan packages or those prospective loan packages out to multiple sources, which might be banks, they might be other independent mortgage bankers. So they get a broad selection of the market. As a result of the largest banks shutting off those correspondent lines, those mortgage brokers now have a much more limited product selection than they had prior to the coronavirus. And as I said earlier, we include home equity lines of credit in that non-conforming bucket as well. home equity lines of credit, for all intent and purposes, have been temporarily eliminated in the U.S. That is not to say that it is not possible for a current owner to access the equity in their existing home through a loan, but that has dropped precipitously in the U.S. and broadly is not available in the current climate. So what does this mean? Well, again, simply stated, it means that loans are going to be harder to come by. You are going to have fewer qualified borrowers or potential home buyers in the market as a result of these increased qualifications. If you're in a second home community and you are relying on that, or that buyer is relying on accessing the equity of their current primary to fund the down payment or acquisition of your product, again, that product, for all intent and purposes, has been eliminated in the marketplace temporarily. So what do you do? What do you do with these changes and with the information that I shared? Well, I think there's a couple of basic things that are really important to be cognizant of right now. And one is to understand what is the capability of the folks that you are currently referring your ultimate end buyer to. So I would imagine that you have a real estate agent that is a specialist in your product that is marketing, and that real estate agent very likely has a common referring partner or partners that they refer the buyers to for financing. It is critically important that you understand the capability of those referral partners. What changes have been made to the products that they offer today? Have they lost product as a result of these correspondent channels being closed or product changes that are beyond their control? If you determine that the product that you are selling requires both conforming and non-conforming product, then once again, you need to understand if the capability of your current mortgage provider covers both ends of that market. It may very well be a time that you need to add bench strength to your mortgage referral partner network. In other words, you may, for a season, need to have both a mortgage broker and a mortgage banker, so that if you've got loan product that's needed by your end buyer that needs to get direct to the source, a Chase Manhattan or a Wells Fargo as an example, you may need to add that to your current capability. I think the other thing that's really important during this season is that you not take for granted the purchase to sale contract to credit qualification process. Most contracts in the U.S. that are written for residential housing have a financing contingency. It is as important today as ever that you understand, as your buyers come in and make offers on your homes, that they have active and current qualification letters. And if you are going under contract today for deliveries that are 4, 5, 6, 8 months out, that those are updated periodically through that process as the market is continuing, to evolve as we go forward. So, in summary, mortgage industry has been highly disrupted by the coronavirus. As we sit here today in the first week of May, things are starting to improve, but we've got a ways to go before we're back to where we were, if we ever return to where we were pre-coronavirus. In the meantime, you need to sharpen up your team with respect to understanding what capabilities they have, and do they cover the breadth and depth of product that you are offering, depending on, again, whether or not you're in the conforming or the non-conforming loan amount space. And it may be a time that you need to add depth to that bench so that you have multiple outlets for your consumer to seek mortgage financing. And you need to be hypervigilant around the credit approval process and the financing contingencies in your contracts, and you need to be checking and double checking as you're working through to ultimately deliver that home. So I hope you found that information beneficial. I want to let you know that on Thursday, May 14th at noon, we are hosting a webinar where we, along with a panel of experts in the industry, are going to dive deeper into the current state of the U.S. mortgage market. If you haven't signed up already, I really encourage you to do so. This will be informative. You can access an invitation or a sign up, at www.builders-capital.com/events. So as always, thank you. Stay healthy and stay safe, and we'll talk to you again soon. Thank you.